Welcome to another Pendal podcast. Since the federal budget, income investing has attracted more and more attention. Interest rates and economic growth, oil prices, geopolitical uncertainty are all swing factors when investing for income. So, how should an investor position themselves, particularly around duration? To answer that question today, I'm joined by Xie Patrick, Head of Income Strategies at Pendal. Good morning, Amy.
Good morning, Sean.
Understandably, some investors have been a bit reluctant to add duration after the volatility of recent years, preferring to stay in short-dated assets or cash maybe. But is there a missed opportunity if you're staying in cash or short-duration assets at the moment? And I suppose the next part of that is how can duration actually help support income and portfolio resilience?
Absolutely. So I think there have been already plenty of events for duration, even over the last 5 years, whilst inflation has been high and interest rates have been volatile. And what this proves to me is that just because inflation is high and yield volatility is high, it doesn't mean that you should completely say no to duration, but it means that your duration allocation at any point in time should be very deliberate and considered and intentional. And so what is happening right now, I think, in the markets is this, this conflict between, of course, inflation is still high, it's still sticky, and we've got the Middle East noise with the oil crisis. But on the other hand, people are wondering, when is this cost of living crisis actually going to dampen growth? And from the perspective of using duration in an income portfolio, you can think about it as two sources of upside if you have allocated to duration and yields are about to fall. The first upside will be through capital gain, simply because duration it works as the multiplier between how much yields move and how much your portfolio returns move. So the more duration that you have, the more that multiplier works in your favor as yields fall. You'll gain from the capital price perspective. But the second gain is really if you don't take those capital gains and instead you just allow there to be more duration on your portfolio, you're essentially securing a higher level of income through a period of potentially much lower interest rates. So you're out earning the interest rate environment in terms of what your income portfolio can deliver. And isn't that the role of income funds?
Yeah. And what if you don't know what's going to happen to interest rates? So I, in a sense, many people look at markets and think about the bond curve and what's going to happen to interest rates, and they just don't want to make a call on it though because it's too hard. How do you manage that?
It is hard. It is hard, and nobody knows. I mean, I make these active decisions, but the job of active investors is to be able to make decisions when faced with uncertainty. And on balance, how yields move ultimately comes back down to economic fundamentals because bond yields are a reflection of longer dated interest rates. And at the very front end of that interest rate curve sits a central bank who is obsessed with inflation, with growth, with employment. So we know ultimately what moves yields up and down. And at any point in time when making that duration decision, it's a probabilistic assessment of what is more likely to come next. Now, I'm far better at doing that, and I bet most are at thinking about what is likely to happen over the next few weeks, next month at most. Far harder to guess, where the cash rate should be in a year's time, or even, in 5 years' time. So we're not heroes at making these duration calls, but right now we see building fundamental evidence to go slightly longer into duration. And the reason we're constraining ourselves and taking only small steps at a time is because there is so much volatility in the price action out there. People are worried about the term premium. People are worried about the US Federal Reserve's new chair being very vague with his guidance. And what does that mean for interest rate volatility and uncertainty? We think ultimately it won't matter. It will come down to fundamentals. But we have to be very disciplined in the way that we allocate to duration when we know that the volatility is very high.
So let's introduce risk into this. Credit spreads look historically tight. Investors increasingly believe some believe they're not adequately being compensated for risk. How do you respond to that idea?
Credit spreads behave very differently to equities, even though they're positively correlated. The major difference is that credit spreads aren't really supposed to go very far in either direction, especially in investment grade. Today for major bank senior paper in Australia at, say, the 5-year point, you're probably getting paid something like 60 to 70 basis points over what a swap curve would give you. And that's not very much. And if all goes well, you'll just hope to accrue that sort of spread as time goes on, and that is the return that you'll get for taking that kind of credit risk. And so when people tell me that they're not very interested in credit anymore because credit spreads are at all-time tights, well, the behavior of credit markets is that for a lot of the cycle, they stick closer to the tights than to the wides of that cycle. The difference in equities, however, is that, of course, most people expect over time, and as it should, equity markets keep marching higher and higher. And so the tightness of spreads in and of themselves is not materially worrisome to me. What will ultimately worry me more is, again, the fundamentals in the economy and in the corporates that we're investing in. And we have to remember that as credit investors, we've positioned ourselves at the very front of the queue if anything were to go wrong. And so whilst we have limited upside, the kind of structures, the seniorities that we're in also limit how much we can lose if everything goes wrong as well. So credit spreads being tight in and of itself, I wouldn't use that as a signal for timing or for how much you should allocate at any one point in time.
Okay, we can't have this conversation without mentioning Alphabet and its kangaroo bonds it issued recently, oversubscribed well and truly, it appears, in Australia. What's your take on buying credit for some of these hyperscalers?
My view has evolved a little bit. So in the first instance, and especially with respect to not so much the hyperscalers, but the outright data center developers, the ones constructing the data centers so that they can, make future revenue off of it. I always thought by being in the debt, whether it's, senior debt or hybrid debt, that you were taking equity market style risk, but for bond style returns. And that's just never a good risk reward calculus. But as it so happens in Australia, we've already had evidence that, not all data center providers are the same, and there are much higher quality ones. Similarly with the hyperscalers, I don't think it's just an equity story. And actually, the worries of the market at large is these hyperscalers are spending too much money and they're going to not make the returns that they're hoping for, and therefore it's going to be bad for everyone. Well, when I think that through, it'll be bad for the equity investors, but as long as they make enough returns so as to be able to continue to pay our coupons and then eventually pay back the maturities of the debt that they're borrowing from, that's okay. And so by our assessment, being able to sit in Australia with these smaller and, definitely relative to the US, far less diverse set of credit issuers that we currently have access to, and then have these hyperscalers suddenly join our market, I think it's a sign of maturity and depth growing in our market, and that our credit markets are going in the right direction.
And I mean, continuing from that, when you're in a volatile period, if you can have a portfolio that's access to all sorts of different assets, flexible liquidity, high quality, presumably, that must help overall, particularly reducing those downside risks.
Of course. I mean, every one of those aspects you mentioned, the higher quality just means that when the prices of everything else falls, the fall in the prices of the higher quality item is going to be less. Liquidity just means that when you demand your money back from your portfolio for whatever reason, you're more likely to be able to get it back even when other things are experiencing illiquidity and being locked up in that environment. And so these are all markers of what you should be aiming to build into a defensive income portfolio at any point in the cycle, but especially right now when there is so much conflict between what is happening on the growth side of the economy and what is happening on the inflation side of the economy.
Amy, thanks for talking to us today.
Thank you, Sean.
You've been listening to another podcast from Pendal. I'm Sean Aylmer.